Good morning, everyone watching live on BAM YouTube. Let me know in the comments where you are tuning in from. The hot sheet covers what you need to know about the real estate industry in a 24-hour time period. On today's hot sheet, I will discuss the first rent decline in 3 years. This is significant news and a major mortgage change from Fannie Mae and Freddie Mac. Today is Thursday, April 20th, 2023. You know what that means. I am Byron Lazine, and the hot sheet starts now. All right, here we go. Let's jump into it on this Thursday morning. Hit the thumbs up if you could. And let's just get right into this rent decline. This is significant news. While everybody is high here on 420, the first rent decline has happened in 3 years. Okay, so a new Redfin report shows the first annual rent decline in the last 3 years, with the median rent dropping 0.4% year over year in March to its lowest point in 13 months. Largely due to the oversupply of multifamily housing. More of that is coming this year. We've been talking about this on the hot sheet for the last 2 months, that this pent up supply of building multifamily housing units, up over 1 million units, are going to hit the market. It's going to drive rental prices down even more this year in a lot of areas where they overbuilt multifamily housing. In February, multifamily housing starts and completions each reached their highest, second highest levels in over 3 decades. So the problem that we have with single family residences, we don't have that in apartments. Remember, they've made it very easy for people to, developers to go out there and build apartments. And that's spurred this oversupply that we're going to experience here before the end of the year in apartments. Rents in the U.S. have seen their first annual drop. It's the lowest point in 13 months. Let's go to the charts, which you can get down below in your daily downloads, all in one link. You'll have all of these charts and sources available. Okay, so you see here now, since March 2020, your first actual drop of the 0.4%. This is according to Redfin. Now, last week we said this is coming. Rents are going down. In your market, maybe they're up. Okay. And I had a conversation with Lisa Chinati on Knowledge Brokers podcast, where she said in Boston, this was 2 weeks ago. So it wasn't this past Friday's episode, but 2 weeks ago, she said rents in Boston or outside of Boston are going up in the suburbs of Boston. Okay, so that's one example. I'd love to know in your market what you're experiencing with rents overall across the country. This is why it's very smart to know what's going on in your market and different pockets, right? What she was experiencing inside the city was different outside of the city. But overall, across the country, we're seeing rents come down where they've really built up a lot of the supply. Places like Houston and others, you will see rents come down if they are not already. Okay, so the decline's not large enough, obviously, for most renters to notice, but overall on scale, as we want to pull shelter inflation out of the equation, this is going to be really good for Jerome Powell and the Fed once this data catches up. We've been talking about that a lot the last few weeks. It certainly doesn't feel like rental costs are falling, not for somebody who's going out there and looking for a rent. Okay. All right. So rents rose as demand grew. So March's median asking rent was the lowest in over a year. This is at now below $2,000. It hit a peak last year over $2,000. You can see still well off of the $1,600 mark for the median mark that was 3 years ago. A Chicago Redfin agent, Dan Close. What a last name for Dan over there in Chicago. Last name Close. I mean, he should be branding the heck out of that. Danny Close, closing the deals, has seen the median asking price. Danny Deals, he'll get jealous of that name, for his market drop 9.2% compared to a year ago. He compares the rent decline to the price of eggs, which has soared over the past several months, but now are returning to earth. Okay, so maybe in his market in Chicago, good comparison there with the inflation on eggs. We did see eggs come back quite a bit. Housing starts completions at the second highest level since the 1980s. So here's that chart showing that we are we're at an oversupply here for multifamilies so this is buildings at 5 units or more. Okay, so it's the highest level. You got to go back to the 1980s. That's insane. Okay, so you didn't have this high of a level until 1980, mid 1980s. Okay, we're talking Atari days here for multifamily starts. Okay, here are the rent decline year over year in 13 major metros. Okay, Austin, that's an area where they did build up a lot of rental, supply. Rents declined by 11% in Austin to 9.2% we just talked about in Chicago. New Orleans is down 3%. Birmingham, 2.9%. Cincinnati, 2.9%. Sacramento is down. Las Vegas, Atlanta, Phoenix, Baltimore, Minneapolis, Houston, 1.5%. I would put in a bet that Houston is going to be closer to the double digits experienced by Austin when a lot of this new supply comes on the market. If you're in Houston, let me know if you agree with that. There is new supply in the apartments, in multifamily hitting the market before the end of the year in Houston specifically. A lot of new development for apartments. I think it's gonna create an oversupply in that market. I think that number will come down for rents. This is good. Again, this is good for inflation. San Antonio is down 1.3%. Interesting, because when we covered yesterday's hot sheet, San Antonio was the one market in Texas that was out of the major markets that was experiencing price increases, right? We looked at Austin and Dallas and Houston having those declines, but it wasn't the case for San Antonio. But here on the list for rent, San Antonio is down. Yesterday's hot sheet broke down a lot of those, or no, that was 2 days ago when we got into that. I'm sorry, that was 2 days ago. Yesterday we went into the declines. If you're listening on pod or on the replay or watching YouTube and you missed any of this week's, definitely go back and check those out. All right, top 10 metros with the largest annual rent increases. So not everywhere are you seeing declines. Raleigh has a 16.6% year over year rent increase. Cleveland's at 15.3%. Charlotte and Indianapolis both over double digits. Nashville, Tennessee almost at 10%. Interesting, because Nashville was one of those markets. Tennessee was up on their home prices, but Nashville was down. But here on the rental side, up almost 10%. Columbus up almost 10%. Kansas City at 8%. Riverside, California, 7.2%. Denver and St. Louis round out the top 10 for metros with the largest annual rent increases. I talked about that Barry Sternlight number a whole bunch. So we've kind of, Redfin is reporting this now, that we're now seeing these rental prices decline. But we got to give props to the Starwood Capital seat chairman and CEO, Barry Sternlight, because he first guessed this on CNBC, and we first reported that here on the hot sheet, where year over year rent growth is going down. He said a couple weeks ago on CNBC, actual rents are declining. Okay, it's that blue line that is going down. But the CPI shelter has it still going up, because they use a 1981 survey where they call Americans at their home and survey them what their rent would actually cost. If people are picking up their home phone, they certainly don't know what the hell their home is going to rent for. So the inflation is being propped up at 34% of CPI inflation is made up of these shelter costs, these actual rent costs, which Barry Sternlight has been reporting for weeks is going down across the country. Now Redfin is validating that these costs are going down. If you go on apartments.com or rent.com, they're going down, down, down. So inflation is the number that they use, that the Federal Reserve uses, that they're going to make decisions on in May when the FOMC meets again. Those numbers are being held up by this lagging data with meaning the Federal Reserve's outdated survey of how they compute shelter. It makes up 34% of that 5% inflation number that you keep hearing about. So when you pull that out, Barry Sternlight believes that when you pull that out, we're only going to be at 2.6% inflation, and the Fed's target is 2%. Okay, so this continued drop in rent is good. It's not good for, somebody who's holding investment properties in a place like Austin or Houston, who, wants to see their rent continue to increase, but it's good for this inflationary measure where we could, get the rates down, and hopefully the 30-year fix will follow. If we can get the rates down, and then we can get some more affordability in home ownership. I think many of you listening to this stream right now would like to see more homeowners, because we know, and we covered this yesterday, disparity in income levels and all of that. We know that homeowners are 44 times more wealthy than the renter. And so it's going to be the fastest path for generational wealth. Okay. I want to show you here how insane mainstream media headlines are with our next topic. And we're going to go through 3 different articles on this Fannie Mae and Freddie Mac change to mortgage. So this is a change that's just announced. You need to know about it. But first, let's break down how insane some of these headlines can read. Let's go to Fox News first. Fox News has been in the news this week. Fox News says a Biden rule will redistribute high-risk loan costs to homeowners with good credit. Let's read through the article, compare it to another article. Then we're going to go to the FHFA. You can make your own. I also have some quotes from a mortgage lender that I'll share with you, breaking this down so you can make your own determination. So a Biden administration rule. Okay, so first, the headline calls it Biden rule, like he came out of, wherever he's hiding and made a decision. Biden didn't make this rule up. Then they say it's a Biden administration rule. This is a Fannie and Freddie Mac rule. Okay, so let's be clear on that. But anyways, Fox News says a Biden administration rule is set to take effect that will force good credit home buyers to pay more for their mortgages to subsidize loans to higher risk borrowers. So I see it here first. I'm like, whoa. We need to know about this. What is going on here? Okay. But when you see something on, and this is what happens, your consumers, the people that you're consulting, might be reading Fox News or CNN and seeing a headline one way or another. It's our job as the professional to dig deeper, find out what the heck is going on here. Because I see that one line. We're going to force good credit home buyers to pay more for their mortgages to subsidize loans to higher risk borrowers. And on the face, it sounds a little odd. Experts believe that borrowers with a credit score of about 680 would pay around $40 per month on a $400,000 mortgage under rules from the FHFA, Federal Housing Finance Agency, that go into effect May 1st. This is right around the corner. We're a couple weeks away, a week and a half, whatever. It's 420 today. Reminder, it's 420. So we're just a week and a half away. Costs to help subsidize people with lower credit ratings also looking for a mortgage, according to Washington Times report on Tuesday. All right, so the changes do not make sense. Penalizing borrowers with a larger down payment and credit scores will not go over well. This is Ian Wright, senior loan officer at Bay Equity Home Loans, told the Times. Okay, so Ian Wright, different take from a senior vice president loan officer that I spoke to this morning. But this is what Ian Wright from Bay Equity Home Loans told the Times. It overcomplicates things for consumers during a process that can already feel overwhelming with the amount of paperwork, all the BS that goes into getting a loan. I mean, do we think he even knows what's going on here? Probably not. And I'm not talking about Ian. I'm talking about the picture. If you're watching on YouTube, they put of course, Fox News is going to spin this thing, right? They put a very confused look on Biden's face here. This is Fannie and Freddie Mac. This is Joe Biden's not walking around the Oval Office coming up with loan changes. I promise you that. The Federal Housing Finance Agency, which oversees federally backed home mortgage companies like Fannie and Freddie, has long sought to give consumers more affordable housing options. One of the problems with these, this is just a little bit off of topic here. One of the problems with the way they keep coming up with affordable housing options is trying to stimulate, and this is another one that you could argue does just stimulate the bottom. Okay. Meaning, let's make it easier for someone to be able to purchase a home that has, low income, or, in this case, low income and low credit. And we talked a whole bunch yesterday again about income levels. So there's some really good data on this in yesterday's hot sheet. But when you just only stimulate the bottom and you don't create opportunities for more supply, which is what we know we need, more housing supply at affordable price points. Okay. You're going to create more competition for these homes. And unfortunately, you can stimulate the bottom as much as you want, but when they're competing against an investor, or they're competing against, somebody with cash or whatever, a lot of these programs just don't work out for the problem that you're trying to solve. So anyways, just a little side rant there on the approach of the government. Oftentimes, I want to see the government do more of what they did down in Florida, for example, where they're giving huge incentives for development of affordable homes, and restricting how those developers are going to put those onto the market. Okay, so anyways, to do this at the onset of the spring market is going to be confusing. Now, this comment isn't from that loan officer. This is from David Stevens, a former commissioner of the FHA during the Obama administration. So, of course, Fox News went and found somebody from the Obama administration that doesn't like this. It's a confusing approach, but it won't work. I don't understand what's confusing, because I found it to be pretty straightforward once it was explained to me, and I'm going to explain it here in just a second. Okay, so let's just get through this Fox News jargon. The rules come as the market has struggled, blah, blah, blah. Okay, so there you go. You can see Fox News is basically saying, this is what Fox News is basically saying. Okay, they're going to be giving this new incentive to borrowers with lower credit scores, but it means that, and they're focused on, anybody with 680 or above is going to pay $40 a month more. It sounds like they're getting a new fee. Okay, maybe not the case. Let's go first to a local, just Huntsville Business Journal. Their headline is very different. Okay, they don't call this a Biden rule. They call it a Fannie Mae and Freddie Mac announced major changes to mortgage financing. So you can see right there the difference in these headlines. New mortgage financing policies from Fannie and Freddie are poised to shake up the housing market for 2023. And here now they're getting into stuff that actually makes sense. Loan level price adjustments, LLPAs, are determined by a number of factors. So when somebody applies for a mortgage, okay, and so I'm going to get into explaining exactly what's happening here. Somebody applies for a mortgage. Lenders go out to adjusters, and they adjust the rate according to their income level as well as their credit score. And so basically, this is what is happening with this new rule that goes into effect May 1st. And I talked to a lender this morning, a senior vice president, William Ravis, who says that, Brian Skelly, who says that this is already into effect. I mean, I guess May 1st, they're going to have to abide by it, but this is already happening. So what lenders are going to be doing is, we're not going to increase rates as much as we did in the past, because there's going to be a new cap on these adjusters on people with low credit and a low down payment. Okay, so people have low income, so they've got a low down payment and they've got low credit. There is going to be a cap on how much an adjuster can increase. And so the way he understands it is that they could be saving as much as $40 a month. Does not mean that on May 1st, the way that he understands it. Okay. And I don't know. And if you're a lender, maybe I'm misinterpreting it wrong. Doesn't mean that there's going to be a new $40 fee attached to somebody with a 680 credit score. It just means somebody with a 680 credit score is not getting this benefit that a low income, low down payment, low credit score buyer would receive. Okay, so that's the explanation that I received this morning. The new policies concerning LLPAs, okay, these loan level price adjustments, these adjusters will reduce the costs incurred for having a lower credit score. There will still be a discrepancy between lower credit and higher credit scores, just not quite so punishing of one. So lower credit had a much higher adjustment. That's why when you talk to a lender, when somebody reaches out to a lender, they say, hey, what's the rates today? Well, it depends. What's your income? What's your credit score? It's going to be different for somebody with a 680. Somebody with a 680 is still going to have the higher benefit, but they're closing the gap on how punishing that benefit is going to be. Okay. So let's go now to the FHFA website and just read directly from there. First, I do have one more from this Huntsville article. I do want to read. This kind of sums it up here. Together with such measures as LLPA waivers for first-time homebuyers with income less than or equal to 100% of the area median income. So to qualify for this, you need to have income less than or equal to 100% of the area's median income. Okay, so these changes are intended to facilitate underserved would-be borrowers by making financing more obtainable. These policies coming into effect in late spring could possibly jumpstart the currently sluggish housing market. Now, I don't agree with that. I think that's, again, I think when you're just creating more incentives bottom up, you're not going to jumpstart the market. The price, the homes that these buyers, these home shoppers would be competing for are already getting multiple offers. So you're not jump starting anything. It's already getting multiple offers. So that's just an insane comment from that Huntsville article. But let's go to FHFA website and get it right from the .gov. They say FHFA announces targeted pricing changes to enterprise pricing framework. So you can see here how insane these articles are, right? The headline of Fox News is Biden rule, like he came up with it. Then they change it to Biden administration in the first line. That's Fox News. This local journal calls it Fannie Mae and Freddie Mac. And then you go to the actual .gov, and it's an FHFA announces changes to enterprise framework. Okay, so very different explanations. Changes targeted to Fannie Mae and Freddie Mac guarantee fee pricing by eliminating upfront fees for certain borrowers. So they're eliminating upfront fees for certain borrowers and affordable mortgage products. And now here they do say implementing targeted increases to the upfront fees for most cash out refinance loans, but not a new borrower who is at 680 credit score or above buying a new purchase. It's someone who's pulling money out on a refinance, cash out refinance loan specifically. Okay, so first-time home buyers at or below 100% of area median income, AMI, which we just covered, in most of the United States, and below 120% of AMI in high-cost areas. That's who's going to be able to qualify. Home Ready and Home Possible loans, Fannie Mae and Freddie Mac's flagship affordable mortgage programs. Those are the programs that it'll qualify for. HFA Advantage, HFA preferred loans, and single-family loans supporting the duty to serve program. So there are some loans that are exempt from this. That would be VA loans, as an example. They're eliminating these upfront fees for certain first-time home buyers, low-income borrowers, and underserved communities. This is Sandra Thompson, the director at FHFA. Today's announcement will result in savings for approximately 1 in 5 borrowers of the enterprise's recent mortgage acquisitions. The new fee reductions will go into effect as soon as possible. Basically, they started to implement on February 1st, but everybody's going to be implementing here, it sounds like, on May 1st. Okay. So that's what's actually happening. I don't believe that this is going to stimulate the spring market in any way. That would be an insane assumption that, lower income borrowers or people at or below the median income, but home shopping and saving $40, per month, $40 per month, nothing to sneeze at. Good savings. Okay. So that's fantastic, but they're still competing for these homes. So when we're stimulating from the bottom up, I just don't know what impact it's going to make. I don't think it'll make any impact. And a lot of times these government tweaks, that make a big splash. Okay, we're going to make housing more affordable. You didn't make housing more affordable with this rule. And on the flip side, Fox News completely spinning this, that Biden is redistributing high risk loan costs. These aren't that high risk of loans to begin with over to homeowners with good credit. That's an insane spin as well. So a lot of clickbait happening here. What's actually happening is people with a lower credit score who are already they're already qualifying for a loan. So these are not high risk loans. They might be higher risk loan than a 680 credit score, but these are loans that are already already going through the system in an environment where we know we have a all-time low foreclosure rate happening across this country. We don't have a risky mortgage loan issue on single family homes. Okay, so these are loans that are already being pushed through, that are now going to save a little bit of money because they're not going to adjust as high as they were in the past. We're not going to increase rates as much as in the past on low credit, low down payment borrowers. That is essentially what's happening here. Again, I don't believe you're going to see any stimulus to bump up the spring market because of this, but there will be 1 in 5 borrowers potentially that are going to save a little bit of money. So there you go on that. Let's take a look at the 10-year and see how it's going to affect mortgage rates today. And we've got a little bit of good news. Thankfully, today, the 10-year is back down under 3.6, where we left the show yesterday, where it was over 3.6. We're down to 3.546. Yesterday's 10-year pushed up this 30-year even more to 6.75. So if you saw my rant yesterday in the hot sheet, I'm sick and tired of people saying interest rates are low. Interest rates have lowered. They're down. They're right back up. 6.75 is just not where we want to be. We need to be closer to 6.5 or under. And we started the week at over 6.5. We haven't seen 6.5 all week. So hopefully today we'll get this thing moving back down in the right direction. The direction you should head on May 5th, Cinco de Mayo, would be into Naples, Florida, where I'm heading back to this afternoon. We've got the BAM Mastermind, and we just sold another spot yesterday. We literally only have a couple spots left. So if you'd like to join us, hit the link down below to do the BAM Mastermind on May 5th. It's an all-inclusive experience. You're going to get your personalized Instagram plan, YouTube plan, as well as the video editing plan, how to get it all done. We're going to spend all day together, do a little bit of golf, and you also get a new BAM product included in this that's not even announced in that landing page. So make sure you sign up for that. That's May 5th in Naples. And then today, 5 p.m., we've got the walkthrough happening. We've got Dan O'Neill in the comments. Dan, maybe in the comments in the live chat, who's going to be on the walkthrough? Dan O'Neill's leading it with, I believe, Paige and maybe Tom Story. I think Tom Story, announcing Tom Story as the BAM creator. And I'm sure they're going to talk about the BAM anniversary, which I haven't even mentioned on the hot sheet. BAM had its 1-year anniversary this week, on April 18th. I haven't said anything about that on the hot sheet because I'm just so focused on the housing stuff that matters in the last 24 hours. So happy anniversary to BAM. 1 year in. Year 2 is going to be insane as we continue to unstuff the stuffiness in the real estate industry. So definitely make sure you're subscribed to this channel for the 5 p.m. premiere episode of the walkthrough, or the premiering of this week's episode rather. And that's all I got for today. I'll see you back here tomorrow when I'm down in Naples live at 9:30 a.m. Eastern, 6:30 Pacific time. And until then, toodaloo. Go get them today, Dan.